Startup and Growth is essentially a bank within the bank aiming exclusively at fast-growing tech companies. So when we meet entrepreneurs, sadly we find that they have very low expectations on what a bank can do for them. They don't really see banks as a partner. We believe that's due to the sort of traditional banking model where you have startups mixed in with anything from hairdressers to carpenters to restaurants in a regular banking concept that also scales with turnover. This works great if you have a sort of linear traditional business, but we see that with startups, you may need to have quite advanced products, coaching, and quite difficult questions early on. So that's why we've built a banking concept that focuses exclusively on tech companies. We have experienced advisors that work also sort of sector specialized, be it in digital health, in entertainment, gaming, or in fintech. We also open up our networks and product specialists very early on, be it in payments or foreign exchange. And what I'm here to talk about today is that we also try to offer financing for startups and scale-ups. And on the right you can see some of the companies we work with, but we work with about 400 fast-growing tech companies in Sweden, from some type of proof of concept, like getting your product out in the market or raising equity, up until some of Sweden's largest tech companies. So, debt financing, and I should say this is quite a complex area that I'm going to try to go through in about 15 minutes. So if you do have questions, please just write them in the chat box and we'll try to address them after the talk. So, traditionally, banks' financing models are built for things with hard assets like factories or real estate. And this is what a scoring model in a bank could typically look at. You look at sort of industry risk, you look at what historical financial numbers have been, what's the value of securities in a company. And to be honest, this works very poorly for startups that are probably more focused on growth than profitability, that may see their income triple every year, which means that you're essentially building a new company all the time. And that's why I would say a very small minority of startups today actually have debt financing. We believe that far from all startups can have debt financing. I mean, if you're not going to be profitable for 5 or 6 years, it's going to be hard to repay a loan. But we see more and more tech companies actually striving to be able to raise financing, and we're actually able to debt finance more companies as well. So if you sit down with a bank that actually understands what you're doing, they will be asking two questions. Should we finance this company? Are they actually able to repay a loan? And things that you'll look at is, as I said, traditionally you will only have looked at sort of historical financials. What we do in Startup and Growth is we try to look at how far is this company from profitability. Okay, they may be focusing on growth for 2020, but is there a plan to become profitable in 2021? That's sort of the first question. Secondly, if we hear this, we need to understand the assumptions behind that. What is the road to profitability? Now, if you've just signed a few big contracts that are going to give you economies of scale, and we can see that gives us a lot more confidence than if you're going to launch an app and you're hoping for a good take-up, for instance. And that sort of helps us determine certainty of predictions. And then we talk a lot about emergency levers. So we see some companies that are just far from profitability because their growth journey hasn't come far enough yet. We see other companies that are sort of in a self-chosen unprofitability. Examples of this can be that you have a profitable core business, but you're focusing a lot on product development, customer acquisition. And if you can highlight those questions to a bank, that can help with a loan as well, because then we can see, okay, if things go south, you can probably cut those costs and achieve profitability again. Now the second question is, once we think that there is a good credit risk in a company, we're also, as are all banks, bound by a regulation, in the Swedish case by the Swedish FSA. And they make each bank have their scoring model, where you need to fit into a certain model for the bank to be allowed to lend. And so your company also needs to be fit into this model. And that is based essentially on two parts. So it's based on current and future income. You can use the model on income for the coming year, for instance. And it's also built on the strength of your balance sheet. So basically, what's your equity to asset ratio? And this is quite good to think about when you're building your company. You may not be thinking about stuff like capitalizing your development costs or how you're counting equity, or sort of if you bring in investor money in terms of loans or as equity. This can make a huge difference for a bank's ability to fund you. Also, company's age plays a minor role, so it's actually quite good to start your company as early as possible to sort of fit into a framework. So moving on, you sort of know what boxes you need to tick to be able to raise debt financing. What can you actually do as an entrepreneur or a startup CEO to meet this? I think one of the things we've been seeing in this past year is companies really adapting their business to their desired funding. Victor will talk a lot more about raising equity, and I think if you want to raise a successful Series A round, for instance, you probably need to show really fast growth. Now, if you feel that the valuations aren't quite right for you, or you don't want to get more diluted and want to raise bank debt instead, you may actually want to slow the growth journey for a year or two to be able to be more profitable and bring in bank debt. And we see a lot of sort of very large startups that have gamed that journey. They've been sort of relying on bank funding for some time, then there is equity for growth, then they go back to bank financing. So see it as that you can actually steer your growth journey to achieve the financing you need. A second thing is we know that all successful startups are very good with their data. And you can actually use that when raising debt financing as well. Oftentimes we see someone simply presenting us with an income statement and a balance sheet, but actually showing, for instance, if you're a SaaS company, showing your CAC to LTV metrics can actually help in a bank discussion as well. So really help someone understand your company. Then there may be, for certain types of startups, there may also be structures in your contracts that allow you to lend. We see a lot of companies that are building business-to-business applications, for instance, and then they end up raising equity because they need to be able to service a very large order. They need to tailor their product to an order. Now, if you're able to make that order and the contract for that strong enough, that may also be basis of lending. Your company may not have been sort of very bankable earlier on, but you may be able to raise debt on the back of that order. And lastly, we also see that how you legally structure your business can be another opportunity to lend. This again is sort of a special case, but we see some companies where they have a sort of a growth engine or a tech platform that is sort of very expensive to build and maintain, that may be hard to fund with bank debt. But then they have another side of the business which is more traditional and is fueled by the tech platform. If you structure it right legally, you may be able to lend to that more profitable part. So don't necessarily see your company as one sort of immutable entity. Now, if we look through the different types of funding available in the whole ecosystem, almost all companies that we come across have started with loans from the Swedish government lender Almi. Those are traditional loans that need to be repaid, but the criteria for getting them are often a lot softer. So it's a good place to start. And Almi has recently received a lot more funding as well to help with the corona crisis. I would definitely talk to them. Then if you look at regular bank debt, it can basically be structured into three parts. So we talk about working capital, which is essentially about funding, your daily business, invoices, capital needs that arise when you sell stuff. That can be structured into an overdraft account, which is a loan that you can increase and decrease the amounts according to needs. That is about the same difficulty to get as a regular bank loan. Then we talk about factoring. So this is something that a lot of companies can use if they're not that strong financially. And that means essentially you take up debt that's secured against the money that's due to you from other businesses. So if I make a huge sale to H&M, for instance, and they're not going to pay me for 60 days, then I can lend against that to cover the costs I have for that order. And then we see certain cases where we can tie financing to certain accounts where payments are due, which we use if the company is deemed risky. Then we have regular loans, which are used to finance sort of growth initiatives or investments. And then we have bridge funding, which we see a few banks doing, and that can be based on if you have an investor commitment but you haven't been able to close your round yet. There are a few actors that will actually lend you money for a short period of time so you can bring in the rest of your investors and close the round. Then if we move away from what traditional banks do, we see a lot of convertibles and owner loans now. That can be helpful to use if, for instance, you haven't been able to set the valuation of your company, but you know that people want to invest. You can do a convertible, and then that changes into equity once you raise. We also see more and more companies doing venture debt. That is debt that is typically not issued by a bank, but from a fund instead, which has a lot higher interests than what we at Nordea would offer. It also often has some sort of warrant, something that converts into equity along the road. But it can be a good alternative for larger fund financing if you don't want to get diluted. And then, of course, the most common source of funding is equity, which Victor will talk more about. And hope to be able to answer some of your questions in the Q&A. But also, please don't hesitate to reach out. Here are some contacts to me and my team. Thanks!